One of the things that happened years ago, I got a chance to interview one of the top heads of credit unions nationwide. And not off the record, but just a little bit of side conversation after. He and I were talking, and he said, man, we really try to do everything we can to help our members be more financially responsible at the credit union, build future financial lives, etc. He said, but as a credit union or as a bank, we have this kind of fundamental incentive that works against people's financial security. And I said, what's that? He said, as banks, and this was one of the most elusive yet totally obvious things. He says, as a bank, we only make money if we lend. Which of course hit me like a ton of bricks, that all the deposits and interest they pay on the deposits are an expense item for a bank. They're not the asset. The asset is the money that they lent. And so we're going to talk a little bit about how banks make money and how the differential in interest rate works, and then how that applies to you, so you can look a little bit differently at how a bank talks about lending you money. And it's even going to change how you listen to the next couple of episodes where we talk about real estate and using lending inside of real estate. So with that, let's kind of jump on this little example. Here's a simple example of money to bank. The outflow that they pay on, say, 100,000 of deposits is 0.5% interest that they're paying.
That's my savings account.
Yep.
Right.
And then they're going to lend that out on a mortgage. And let's just say they get a 30-year fixed mortgage that they've lent out to somebody, and they get 3.5%. Now, here is the quick math that we all do. And in fact, early on, being taught by big box financial retail when I started in this career over 20 years ago, I know I don't look that old, but I feel older every day.
Underneath the beard.
Underneath the beard. The grays on the inside. You got to keep it in the core. That we look at that and say, oh, it's just 3% difference, 3% rate of return. Now, banks don't open locations all over the world, have secure websites, thousands and thousands of employees on 3% rate of return. But this is the way we're traditionally taught to look at it, but that's not how to look at it. In fact, when we have to pay out the interest, if we're a bank, at 0.5%, that's $500 in cost. That's the investment. Then they get back $3,500. So very quickly you start to discover, wait a second, if I put $500 somewhere and I get back $3,500, that is not a 3% rate of return. It's 600% rate of return. Now, once again, for our math geniuses listening, this is the danger we get into these asset class conversations. Yes, we're not talking about fractional reserve banking and going any deeper into that at this time.
Which would only make it a higher rate of return if we did.
That's right. But the other thing we're not counting is, of course, the bank has overhead expenses, fixed costs, variable costs with employees, ATM fees, all that. But the thing is that I'm pointing out, and Cory is pointing out, is that it's not a 3% difference. It's a 600% difference, because we have to look at the dollar value of those growing. We talked about that all the way back in the illusions of investing. People think, oh, it's just a 2% rate of return difference. No, it's a gradation of the smaller rate of return we're trying to improve. Now let's think about how we look at it for our own personal balance sheet. We talked just a minute ago in the episode about why we may want to keep control of our money. Now, in this case, what we're going to do is assume that we as a homeowner, to control our capital and not put it all down in down payment, are going to pay 3.5% cost of money. Using our example of that family, an extra $600,000, but we're only going to analyze $100,000 of it, just like we did the bank. And we look at the fact that we pay 3.5%, and then we hope to get 6% in our investments. That's the example here. That's a 2.5% rate of return. And people look at that all the time and say, it's not worth it. It's just not worth it. I'd rather just put the money down on my house. And once again, though, it's not 2.5%. What is it? Well, we're sending out $3,500 a year in interest to that extra money that we didn't put down on the house. And then if over time we're getting 6% coming back to us, the difference between those two is $2,500. That is a 70+% rate of return on the money we had to pay to keep the debt service, to keep control of our money, and allow it to stay invested on our balance sheet.
So if you're only getting 0.5% in a savings account, you're used to getting 6, 7, 8, 9 in a market-based investment account, that the spread doesn't even have to be that big to be a compelling alternative between the two.
Exactly right, Cory. You could see that you could narrow this down. You could do the math yourself.
Right.
Narrow your return down to 4 or 5. It's still not a 1.5% rate of return, because it's money that we weren't going to control anyway. Money that provided no return if we locked it up in home equity. All it did was alleviate our cost of interest. And just like a bank, your return can be well in excess of the simple math differential and difference between what you're paying for money and what you're getting as return on money. Hey guys, so glad you could tune in and watch that video. I want to remind you to subscribe. Be sure to hit the notification bell so you can get the latest piece of financial knowledge we release. And don't forget, go to Amazon, get a copy of Sound Financial Advice. Why? Because it'll make you better looking and smarter.